In the heart of Frankfurt, a gleaming skyscraper rises 185 meters into the German sky. This isn't just another corporate headquarters, it's the European Central Bank. And the decisions made inside this tower directly affect the wallets, savings accounts, and daily purchasing power of over 350 million Europeans. When you buy groceries, take out a mortgage, or watch your savings grow or shrink, the ECB's fingerprints are all over those numbers. But how did a single institution come to wield such extraordinary power over an entire continent's economy? And more importantly, who really controls the controllers? To understand the ECB, we need to travel back to the 1990s, when Europe was embarking on its most ambitious project since the Treaty of Rome. The Maastricht Treaty of 1992 didn't just lay the groundwork for a common currency. It created something unprecedented in modern history: a central bank without a state. Think about that for a moment. The Federal Reserve answers to the United States. The Bank of England serves the United Kingdom. But the ECB would serve 20 different nations, each with its own government, fiscal policy, and economic priorities. The euro was launched in 1999 as an accounting currency, with physical notes and coins following in 2002. Today, 20 countries use the euro, from economic powerhouses like Germany and France to smaller nations like Malta and Estonia. This diversity is both the ECB's greatest challenge and its defining characteristic. So what exactly does the ECB do? Its primary mandate, enshrined in European treaties, is deceptively simple: maintain price stability. In practice, this means keeping inflation close to, but below, 2% over the medium term. Why 2%? It's a sweet spot that allows for economic growth while preventing the corrosive effects of high inflation that erode purchasing power and savings. To achieve this target, the ECB controls the Eurozone's monetary policy through several key instruments. The most visible is the interest rate, specifically the rate at which commercial banks can borrow money from the central bank. When the ECB raises rates, borrowing becomes more expensive throughout the economy. Mortgages cost more, business loans tighten, and consumer spending typically cools. Lower rates have the opposite effect, stimulating economic activity by making money cheaper to borrow. This is the lever that most directly touches your wallet. But the ECB's toolkit extends far beyond simple interest rate adjustments. The bank also sets reserve requirements for commercial banks, conducts open market operations, buying and selling securities, and serves as the lender of last resort to the Eurozone's banking system. During normal times, these technical operations hum along quietly in the background. But when crisis strikes, the ECB's true power becomes starkly visible. The 2008 financial crisis and the subsequent Eurozone sovereign debt crisis between 2009 and 2011 forced the bank into uncharted territory. Suddenly, maintaining price stability wasn't enough. The very survival of the euro itself hung in the balance as countries like Greece, Ireland, Portugal, and Spain teetered on the edge of default. This is where the story gets controversial. In July 2012, ECB President Mario Draghi uttered 3 words that would define his tenure and fundamentally reshape the institution: whatever it takes. Speaking in London, Draghi pledged to do whatever was necessary to preserve the euro, adding with deliberate emphasis, "And believe me, it will be enough." Markets rallied. Bond yields for struggling countries fell. The immediate panic subsided. But Draghi's promise required the ECB to venture far beyond its traditional role. The bank launched an unprecedented program of quantitative easing, eventually purchasing over 3 trillion euros worth of government and corporate bonds. It pushed interest rates into negative territory, meaning banks actually paid to park money at the central bank. These weren't just technical adjustments, they were revolutionary policies that sparked fierce debate across Europe. German economists and policymakers were particularly critical, arguing that the ECB had overstepped its mandate and was effectively financing government debt, something explicitly forbidden by European treaties. They worried about moral hazard. If struggling countries knew the ECB would always bail them out, what incentive did they have to implement painful but necessary reforms? On the other side, economists from Southern Europe and many international observers argued the ECB hadn't gone far enough. They pointed out that the Federal Reserve and Bank of England had acted more aggressively and earlier, and that the ECB's initial hesitation had deepened the crisis. This tension between Northern European fiscal conservatism and Southern European calls for more aggressive intervention remains at the heart of ECB politics today. The bank's governance structure reflects the delicate political balance required to manage such diverse interests. At the top sits the Governing Council, which makes all major monetary policy decisions. This council comprises the 6 members of the executive board, including the president, plus the governors of the 20 national central banks from Eurozone countries. Each member gets 1 vote, regardless of their country's economic size. This means the governor of Malta's central bank has the same voting power as the governor of Germany's Bundesbank, even though the German economy is roughly 150 times larger. It's democracy applied to monetary policy, and it creates fascinating dynamics. Decisions require consensus building across vastly different economic realities. Ireland might be experiencing a property boom, while Italy struggles with stagnant growth. Greece might need stimulus, while Germany worries about overheating. The ECB must craft a one-size-fits-all monetary policy for economies that often need very different medicine. Since November 2019, this complex institution has been led by Christine Lagarde, a French lawyer and politician who previously served as managing director of the International Monetary Fund. Lagarde brought a different style to the role compared to her predecessor Draghi, an economist and former Goldman Sachs executive. Where Draghi was technical and market-focused, Lagarde emphasizes communication, political savvy, and broader issues like climate change and inequality. Under her leadership, the ECB has incorporated climate considerations into its monetary policy framework, a move applauded by environmental advocates, but questioned by those who believe the bank should stick strictly to its price stability mandate. She's also navigated the unprecedented economic disruption of the COVID-19 pandemic, launching emergency bond buying programs and maintaining ultra-loose monetary policy to support the Eurozone economy through lockdowns and supply chain chaos. As of late 2024 and into 2025, Lagarde faces a new set of challenges. After years of ultra-low and even negative interest rates, inflation surged in 2021 and 2022, driven by pandemic-related supply disruptions and Russia's invasion of Ukraine, which sent energy prices soaring. The ECB responded by raising rates multiple times, starting in June 2024, breaking from years of stimulus. By October 2025, the bank held rates steady for the 3rd consecutive time as inflation appeared under control at around 2.2%, and the Eurozone economy showed modest resilience with 0.2% growth in the 3rd quarter. But new headwinds emerged, particularly from US tariff policies that Lagarde noted were holding back European manufacturing alongside a stronger euro that made exports more expensive. This brings us to a fundamental question. Does the ECB have too much power or not enough? Critics from the political left often argue that the bank's obsession with price stability ignores unemployment and inequality. They point out that the ECB's mandate is narrower than the Federal Reserve's, which is explicitly tasked with both price stability and maximum employment. Meanwhile, critics from the right worry about the bank's independence being compromised by political pressure and its balance sheet bloated by years of bond purchases. There's also the awkward reality that the ECB controls monetary policy, while fiscal policy remains firmly in the hands of 20 separate national governments. This creates a fundamental asymmetry. The ECB can lower interest rates to stimulate the economy, but it can't force governments to spend more or invest in infrastructure. Conversely, if a government runs up massive debts, the ECB faces pressure to keep rates low to make that debt serviceable, potentially compromising its inflation-fighting credibility. So how does all this actually affect your daily life? Let's make it concrete. When the ECB raises interest rates, as it did repeatedly in 2024, the cost of borrowing increases across the Eurozone. If you have a variable rate mortgage, your monthly payments go up. If you're planning to buy a car or start a business, loans become more expensive. On the flip side, savers finally see positive returns after years of earning virtually nothing on deposits. When the ECB cuts rates or maintains low rates, the opposite happens. Borrowing is cheap, which can fuel investment and consumption, but savers suffer and asset prices, particularly real estate, tend to inflate. The ECB's policies also affect the euro's exchange rate. Higher interest rates typically strengthen the currency, making your vacation to the United States or Asia cheaper, but hurting European exporters who find their goods more expensive for foreign buyers. Lower rates weaken the euro, boosting exports but making imports pricier. Perhaps most directly, the ECB's success or failure at controlling inflation determines your purchasing power. When inflation runs hot, your salary buys less each month. The 50 euros you spend on groceries doesn't stretch as far. Your savings lose real value even if the nominal number in your account stays the same. This is why the 2% target matters so much. It's low enough that you don't constantly worry about rising prices, but high enough to avoid deflation, a dangerous spiral where falling prices encourage people to delay purchases, which reduces demand, which causes more price falls, and so on. Japan's lost decades serve as a cautionary tale of deflationary stagnation that the ECB is determined to avoid. Looking ahead, the ECB faces profound questions about its role in an evolving Europe. Climate change is forcing a rethink of how central banks assess risk. Should the ECB favor green bonds over fossil fuel company debt in its purchase programs? How should it account for climate-related financial risks? Digital currencies present another frontier. As cryptocurrencies and private digital payment systems proliferate, the ECB is developing a digital euro, a central bank digital currency that could fundamentally change how Europeans use money. Then there's the geopolitical dimension. As the United States and China increasingly weaponize their financial systems, European leaders want the euro to serve as a genuine alternative to dollar dominance. But that requires deeper integration and coordination that many member states resist. The European Central Bank remains one of the most powerful yet least understood institutions in the modern world. It's an experiment in supranational governance, attempting to manage a currency union without a political union. It's a technocratic institution, making decisions with profound political consequences. And it's a constant balancing act between 20 different national interests, between inflation hawks and growth doves, between market credibility and political pressure. The next time you check your bank account, pay your mortgage, or notice prices rising or falling at the supermarket, remember that tower in Frankfurt. The decisions made there ripple through every corner of the Eurozone economy, shaping opportunities and constraints for hundreds of millions of people. Understanding the ECB means understanding one of the key forces shaping Europe's economic future and, by extension, your own financial reality. I hope this exploration has helped demystify how the European Central Bank operates and why its decisions matter for your daily life. If you're interested in continuing to explore European economics, monetary policy, and the geopolitical forces shaping our world, I invite you to subscribe to this channel. Hit the notification bell so you don't miss future analyses, and share your thoughts in the comments below. What aspects of the ECB's work concern or interest you most? Let's keep this conversation going as we navigate these complex economic waters together.